Touch on something Mark said earlier. Mark said about the guy who invested 10 grand into Uber and turned into 23 million quid or whatever it was, and how you shouldn't expect that from us. You shouldn't, don't get me wrong, 2,300x is quite an ambitious target. However, EIS is no longer capital preservation. Therefore, if you're looking at a fund that's targeting a return of less than twice your money back after 5-6 years, does your client really care about getting 10% per annum return from a high-risk investment? So when you're looking at these funds, one thing I would say is balance out the risk and reward. If the fund manager isn't going to return you a decent level of return for the amount of risk that you're taking, why bother? For those of you who haven't heard, SidebySide are a relatively newer fund. So we were formed originally back in 2016. We ran as a family office for a few years. We launched our first public fund in late 2019, and it's the EIS that I'll be talking to you about today. One thing we look for that differs slightly from what you will hear and have heard so far is rather than going after the bloke in the shed type company with the next bright idea that's going to change the world, we look at something called later stage, which rather than defining seed, series A, B, C, whatever, we look at companies that are already producing over £1 million of annual revenue before we invest. Because no matter what set of data you look at, the number one reason that boils down to why companies fail is because not enough people buy enough of what they're selling. So for us and for you, the easiest way to mitigate against that risk is to buy into companies that are already selling a decent chunk of whatever it is they sell. Rather than buying into a marketing deck and a dream, we're buying into a proven business, proven customer fit and acceptance. So, why we exist, I'm going to skim through this because Jess from Hatch has already touched on it, but the UK is very good at starting companies. We started some 810,000 businesses last year. Now, pandemic, a lot of people working from home, wanting to sort of branch out, but nonetheless, we started a hell of a lot of companies. Now, the difference is, whilst we started that many companies, there's only 0.1% of those businesses that will reach what the Treasury deems a significant size. That 0.1% contributes to 40-odd% of all UK employment and 30-something% of all UK tax receipts. So from a government, Treasury, policy point of view, it's very important that we can turn those 810,000 startups and get more across the 0.1% threshold. Because it's actually from a skill set point of view, and what a lot of founders find is growing your business from startup to 100,000, £500,000 of revenue takes a certain passion, skill set, and all the rest. Taking a business from £500,000 to £10 million of revenue takes a whole different set of skills. And that's where we typically come in. So what we look for, strong management team sounds pretty stupid because no one's going to invest in a weak management team. But where we say that, we actually mean we look for companies that are starting to sort of outgrow the startup infrastructure. They're starting to realize that maybe their mum shouldn't be head of HR anymore. Maybe their mate from school who was really good at computers shouldn't be their chief tech person. So as they're starting to outgrow that startup infrastructure, that's typically where we come in. £1 million of annual revenue, pretty self-explanatory, I've already touched on. Opportunity to scale, because again, this is the other sort of common misconception. If we're going for later stage businesses, are they the slow and steady type juggernauts that couldn't adapt to save their lives? The average revenue growth across the portfolio was doubled in the last 12 months, year on year. So these are still companies that are scaling. We're not looking for the 0 to 100,000. We're looking at bigger companies, but even still, these companies have still got a lot of room to go. Sector-wise, we say tech-enabled, which, don't get me wrong, we're sector agnostic. We could invest in absolutely anything, and I'll touch on a couple of examples later. But we essentially look for companies who are utilizing tech to get ahead in whatever they do. So in terms of do we know what we're doing? So between the management team, so our founder, John, his first company, he designed basically a CRM system for the pharmaceutical industry. Started it off in Australia, took it over to the States, spent a long time scaling it, and eventually exited for just shy of 700 million via a NASDAQ listing. Now, the point behind that is, over the last 30 years, there have been some 40-odd single company investments from the management team, delivering just over 19x ROI. And the total exits to date have been just over $1.5 billion. So, how do we find it. As others have touched on this morning, there is no real exclusive deal flow unless you're looking at university spin-outs and things like that. Most other funds will talk to most of the companies that we talk to. But actually, we get a lot of referrals from angel investors, so people who are already invested into our portfolio companies and who are looking for, people who add value, and they have other companies in their portfolio that they refer us to. We get referrals from the founders that we funded, and also we've had one so far from founders that we haven't funded. We spend a long time with the businesses before we invest, and even typically with most investments that we make or haven't made, we will then spend a long time talking to them afterwards. We have a lady here, Alicia, who manages our sort of deal flow, and actually what she does is sort of keeps in contact with every single company. None of the kind of hard and fast, nope, we'll see you, we'll sort of never see you again. It's keeping in touch, because if a company might not be right for us today, that's not to say they might not be in 12 months' time. And the point of keeping those relationships alive is if we're talking to that company in December, and they say sort of throwaway comment about we might be raising in March, we can then get our interest in quickly before they go out to the market. We also hold relationships with some of the corporate finance houses, PwC, WH Ireland, Numis, and others. So, once we find the companies, once we've decided they're right for us, how do we operate? We are what we say are operators rather than consultants. There are some great funds out here where they have half the alumni from investment banks, management consultants, and everything else. That's not us. Every member of our management team has either founded, worked in, turned around a startup company. Because for us, when we're looking at companies, one, our value add to the entrepreneurs is that we've been where they are, or we've experienced what they're going through. And at the end of the day, if it comes down to one of the portfolio companies is in crisis, do they want someone that scaled a business, or do they want someone that will help them draw a nice spreadsheet? For us, it's about the value add that we bring to the companies. We're a focused fund, so we don't buy into the spray and pray, 100 companies and 70 might go to the wall, but out of the sort of 5 or 10 that do well and the 20 that break even, that's where our return is. So we will focus each fund at about 20 companies. That means that we can spend real time with each company and actually, get right into the weeds, not just turn up once a quarter and wonder what's going on. Transparency shouldn't be a brag, especially in a regulated business, but I've put it up there because everyone else says they're transparent, so may as well sound the same. The main point with this is, I say it's not a brag. We, for example, our investor reporting, every single investor in every single one of our companies receives a quarterly report with full financial management accounts. Every expense line is there. If they want to know how much the company spent on travel, whatever, it's there. No redacted stuff about we can't tell you this because whatever. Everything is open. So when it comes to actually managing your clients' expectations and managing yours as the advisors, because there's nothing worse than, you get the sales messaging for the last 6 months saying this company is shooting the lights out, great news, they've just signed Amazon as a client, and next week they go bust. So from this point of view and transparency, it's about making sure that yours and your clients' expectations are managed. Hands-on, as I said, we don't just turn up for the quarterly meeting. We sit down with each company roughly about twice a month. It's been a bit more over the last 18 months, but nonetheless, we talk to each company. We're involved with their kind of business development, their marketing, whatever it may be. And that's not from a kind of overbearing, micromanagement. It's from a point of view of we're there to help. We are a resource to them, the same as, some of you may buy in a compliance service or something like that. That's our value. Skin in the game. Skin in the game seems to mean different things to different people. So the overarching thing, us, the management team, every employee at SidebySide invests into the fund, as Jess touched on, exactly the same terms as an external investor. What skin in the game actually means that's important, though, is, if we've got someone who's worth 100 million, who's put 100 grand into the fund, doesn't move the needle if something goes wrong. For the rest of us who haven't made hundreds of millions, if we're investing 10, 20, whatever £1,000, that's quite a large material portion. For the regulator, it's not over more than 10%. Nonetheless, it's a large proportion. If something goes wrong to it, that's painful. That's what skin in the game means to us. Lastly, paid on actual performance. Slightly contentious point, but nonetheless, our hurdle rate is set at 150%, Because as I touched on before, and our target return is 3x of capital. Because as I touched on before, this is not capital preservation anymore. A fund manager giving you your money back after 6 years and then taking a performance fee on the 10% profit they've made, that's not performance. That's safeguarding, it's custodian of assets. So for us, until we've returned 150% of exactly what your client invests in the whole fund, there are no performance fees. In terms of does it work, as I said, relatively newer fund, so there's no exits from the fund to speak of yet. However, looking at third-party only valuations and externally priced rounds, our 2019 cohort of investors is currently up 71%. Don't know why the slide's like that, but nonetheless. Our 2020 cohort is currently up 49%. These are all unrealized, but nonetheless, externally driven pricing. And the average revenue growth across our portfolio companies is currently just over 2 times. Now the difference, 2 times doesn't sound impressive compared to the 50x's that you can see in startups. But that's 2 times of an average revenue figure of just over £3 million. So it comes back to law of large numbers. COVID, I'm sure everyone's bored of why asset managers are, so adapting to COVID. We're great. One thing to sort of really point out with our COVID response, if you like, is most of these investments will last longer than a lot of marriages. We have to get used to the company. We have to know the company will work well with us and that we will actually add value. We're not going to bother investing and wasting one of our slots in our fund if we're not going to add value to the company. So one of the things, although we can do Zoom meetings or whatever else it may be, one of the things that didn't change is the due diligence process that we go through. Because whilst there are a hell of a lot of funds with a lot of money available to start up, if you have a great business at the moment, you can raise funding from almost anywhere. The difference is we have to sort of pitch our value to the companies of why they work with us, because equally they could go down the road and get the same check. But it's about what we add. So that due diligence process for us is ensuring that that long-term relationship is going to work out. Slightly higher failure rate than most marriages, but nonetheless. Touching on the portfolio. So, as I said, we are sector agnostic. This is probably one of the least sexy sectors we're invested in, but nonetheless, this is Laundryheap. Now, from a consumer's point of view, any of you in this room today can go onto their app and within an hour get your dry cleaning picked up, or your dirty dry cleaning picked up. They'll take it away, bring it back to you the next day within 24 hours, cleaned, pressed, whatever else. Behind the scenes, and I hate this cliche, they subscribe to the kind of Uber for laundry model. Because Laundryheap don't actually own any laundrettes. They don't sort of employ full-time drivers. Everything is outsourced. So what that means from the sort of actual real-world scenario is that, it's actually a moonlighting Amazon driver that picks up your laundry, takes it off to a commercial laundry premises, and then someone else brings it back. What that means in terms of numbers is not only were they named one of the FT's fastest growing companies in Europe last year, but they've done just shy of £7.5 million of revenue this calendar year, and they're forecasted to do £18 million of revenue next year. This is where I say we come in at a later stage, and this is why we're not sort of sector specific. We just look for companies using tech. How many of you have been on holiday since COVID and masks and everything like that? Okay. This is normally the biggest pain in the arse of the holiday, is waiting for your bags with 400 other people. So our second company to highlight is a company called Sherpr. Again, from a consumer point of view, Sherpr will pick up your suitcases, golf clubs, skis, whatever it is you're taking with you, a couple of days before you go on holiday, and they're then waiting for you when you get to your venue. How they do it is using, commercial cargo networks and things like that. But from the consumer's point of view, that's what you see. Now, we backed these guys in March of this year, so when travel was still a little bit more difficult. We went in, we got what we thought was a great valuation, but more importantly, we backed the idea and their plans to scale. So for us, Sherpr was looking at multiple different markets. Whilst international travel was down, there were still things like staycations. There are, at any one time, 500,000 international students in the UK. So again, targeting markets like that and niches that they hadn't previously operated in enabled them to scale revenue 350%. They're expected, the run rate's about 1.2 million at the moment, and we're forecasting about £4 million of revenue for them next year. On to the team. I won't spend too long on here because we're actually all here today, so please come and have a chat with us. we're more than happy to explain what it is we do and what we have done. Fees and charges, again, always a fun point because it always gets asked. So we don't charge our initial or ongoing fees to the client. There is no right or wrong way to do it. There are funds that will argue that there is, but nonetheless, for us, this is a tax-driven decision choice for most clients. But once you've decided that an EIS is right for your client, tax relief goes out the window because every single fund here will give you the exact same tax relief. My 30% isn't going to be less worth than someone else's. Sorry, worth less. So the important thing is, treat these funds as an investment choice that you would with any other investment fund. But from our point of view, the reason we leverage our charges against the investee company is so that from an EIS point of view and a tax planning point of view, 100% of what your client invests will be invested for EIS relief. That's the last time I'll mention tax relief, I promise. Performance hurdle of 30% over 150, and the reason it's important for us to have that based on the overall portfolio is if your your performance fee is based on a company-by-company basis, 100 grand invest into 10 companies, say that it's equal splits, 6 of them go bust, 2 of them break even, 2 of them do a 4x return. Your client's still down overall, but that fund manager's taking a performance fee on the ones that did well. That's, again, not performance, hence why we say on a total portfolio basis. Co-investor and the Enterprise Investment Scheme Association, where Mark is from, have launched a fee transparency initiative. Because again, it's not actually just the fees that your client pays initial, it's what the company's charged. There was like 36 different words for fees and charges when they did this research. Directors' fees, consulting fees. It's all something that's paid either by your client or by the company. So for us, we subscribe to this. There are about 10 or 11 funds that do. We subscribe to this so that you and your client can see every single penny that is charged against their investment, either to them or to the investee company. And again, shouldn't be a brag, but it comes back to transparency. See, we support advisors, we do things like this. I don't think it's, again, innovative to say that we have a digital application, because anyone that hasn't done any business in the last 12 months. Client portal, because again, admin is a particular burden with this market and can be very, time-consuming for you as the advisor. So all EIS3s, client reports, quarterly reports, contract notes, all uploaded to the client portal. You, the client, and the accountant, if you wish, have access to that. We also have events, where you can come along, bring your client if you want to, meet the founders of the companies, see the whites of their eyes, understand more about the business. And lastly, we have a always there service. Therefore, if you're writing your suitability report of an evening outside the traditional 9 to 5, there's an email address and a phone number that you can send a message to. You get a call back within an hour. So, in summary, this is a fund formed by our own experience. And although everyone, we say to you, past performance is an indicator of future, and although the fund itself is yet to have the exits because we're still within 3 years, there is a strong track record, and not only of exiting companies, but also buying them. So that when it comes to one of our companies wanting to sell, we like to think we sort of know the basis of what the buyer is looking for, as well as what they're looking for when they sell. Skin in the game, hands-on support rather. That's the most important value add that we have as a fund. It's not about the money, it's not about who we are, how snazzy the branding is or anything else. It's about the value that we add to our portfolio companies. Skin in the game, as I've touched on, not only investing in the fund on the exact same basis that an external investor would, filling out the same paperwork, paying the same fees as just touched on, everything else. It's about having the fact that we have aligned our interests with investors, because actually, why would I be standing here selling something if I don't believe it enough to invest in it myself? Lastly, as I touched on, the easiest way we can see to mitigate the number one reason that businesses fail is by investing in the stage after that. Don't get me wrong, these companies, although they're later stage, they're still high risk, they can still fail, but the difference is, when they're getting to levels of £7.5 million of revenue, something has to go quite a bit wrong for them to for them to fail like that. And that's where the hands-on support comes in, because we're in there, because we're working with them every month. we like to, we can't see around corners, but again, we work with them to give them the best possible chance to. We had a deployment this week, so you're too late for that one. We have another deployment on the 1st of April. So any client in between now and the end of the tax year, if they wish to be fully allotted this tax year, we can absolutely do that. Come and have a chat with us. As I said, there's a few of us here. Thank you very much for your time. And yeah, look forward to talking to you soon.